It's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. In mid-September, Rockefeller Asset Management, the asset management arm of Rockefeller Capital Management, and KraneShares, a leading global ETF provider specializing in China, climate, and uncorrelated assets, launched the KraneShares Rockefeller Ocean Engagement ETF, ticker KSEA, and I'll refer to it as KC. The fund invests in public companies with significant impact on oceans and ocean resources, reflecting the meaningful investment opportunities within the blue economy. KC aims to generate competitive returns and improve ocean health through shareholder engagement activity focused on pollution prevention, carbon transition, and ocean conservation. And its holdings include companies from diverse sectors such as aquaculture, commercial fishing, waste management, renewable energy, and logistics, among others. And my guest today is Casey Clark. He will discuss this new ETF. Casey is the president and chief investment officer of Rockefeller Asset Management. So, Casey, tell me about your background, your career path, and your role now as president and chief investment officer of Rockefeller Asset Management.
Happy to. First off, I did not pick the name of that ticker. Although the ticker's KC and my name's Casey, I had nothing to do with that, despite beliefs to the contrary. I oversee Rockefeller Asset Management, one of three divisions at Rockefeller Capital Management. So Rockefeller Asset Management, just brief overview, $12 billion in assets across equities, alternatives, and fixed income. Right. We increasingly focus our time on differentiated strategies within niche asset classes where we believe we can capitalize on a market inefficiency. And we joke and talk a lot about we don't want to compete with the trillion-dollar managers. We want to operate in categories that don't move the needle for them. And why is that? Because we have a higher probability generating alpha there. So just to give an idea, I mentioned equities, alternatives, and fixed income. Within equities, think high conviction, bottom up fundamental research, think 40 to 60 stock portfolios, whether that's global equity, international, or US small cap. We also have thematic, which here to talk about ocean, but same thing. Think high conviction, bottom up, 40 to 60 stock, global equity portfolio, investing alongside megatrends. Within alternatives, we do have a long short strategy. While we're not here to talk about that, in a venture fintech innovation strategy. And then within fixed income, we also have a burgeoning taxable, tax-exempt, preferred, and cash management business. And love to say, or my compliance team would love for me to say before, right? Not a recommendation to buy or sell any security or strategy as we speak. But Bob, hopefully that gives you a little bit idea about me and our division and what we're offering.
It certainly does. So, looking at your style, high conviction, bottom up, fundamental investing, what are the categories that you're finding attractive right now for our audience of advisors?
So for advisors specifically, I think of two attractive areas of asset management. One, I'll call asset classes that are more challenging for advisors to execute on without a third party. Two are asset classes that advisors can manage, but it distracts them from growing their business. So in that first category, what are asset classes that are more challenging for advisors to execute on without a third party? So think US small cap, municipal high yield, long short, private equity, private credit, niche, differentiated, uncorrelated. That's where I believe you're going to continue to see kind of long-term flows in attractive areas. In that second category, where we think more about how do we remove a headache for an advisor, how do we free their time to grow their practice, it's things like investment grade fixed income, right? Managing hundreds or even 25 to 50, low minimum fixed income, separately managed, tax efficient accounts is time consuming. And then you have things like direct indexing and passive, which has continued to gain more and more flow. So broadly, those are the asset classes where we believe there's just going to be stable to growing asset base in the years and decades ahead.
So you've chosen to specialize in what I call capacity constrained asset classes. Why is that? How does that help advisors build their practices?
It's simple. Alpha. It gives us the highest probability of generating alpha. And when we think about, how do we support advisors, we think about performance, access, and reporting. Performance, access, reporting. Performance through alpha, access through access to portfolio managers and investment intellectual capital, and then reporting, efficient and effective reporting that they can deliver to their clients. But it's also more than just, and this I feel like will segue eventually into the ocean engagement strategy. It's more than just capacity constrained asset classes. It's asset classes or themes where we think we can capitalize on a market inefficiency. And one of those things that you hear us talk a lot about are ESG improvers. I bring that up too, because that segues into the ocean engagement strategy and just broadly, why we're thinking about capacity constrained asset classes or differentiated views, because we want to deliver that alpha.
Casey, expand on what you mean by ESG improvers.
We've written a lot about the world over the years. The world will differentiate between ESG leaders and improvers. Leaders are the classic best in class, worst in class. You see these written about a lot in the media. Improvers are companies that are showing the greatest improvement in their overall footprint. So in other words, it's an investment philosophy that's more aligned with the ethos of a value investor. You could be investing in a company that's in the bottom third or low from an ESG laggard, or maybe not considered a darling by any means, but that you think it's going to show the greatest improvement. And we believe that's where you can generate alpha over the long term. And to us, this is just part of good investing. You think about looking for companies with improving revenue, improving earnings, improving margin, improving competitive moats. You want to buy companies kind of at the low. You want to see the improvement, and potentially when that improvement's realized in the ideal state, you sell those. So to us, it's no different between leaders and improvers. And we've approached the space like that for the most part.
Well, let's make that segue. As I mentioned in my introduction, alongside KraneShares, you just launched the ETF KSEA. It has an expense ratio of 86 basis points. What led you to introduce that ETF, and what's the strategy behind it, and what role do you see it playing in a portfolio, especially in the context of portfolio diversification?
What led the launch of this strategy? The ocean is one of the most unifying themes globally. It doesn't matter where you are in the world. Uh, um, most people have a very kind of fond view and fond memory of the ocean and how to improve ocean health related issues. There's also performance tailwinds and fits within a portfolio, complements a portfolio that we could talk about. But to set the stage, right, think this is global equity, long only, high conviction, 40 to 50 stocks. As you mentioned, we're looking to deliver alpha along with positive ocean health. Think 5% plus tracking error. And I think if you look back through the statistics, it's 7% plus since we've been running it. So high tracking error portfolio. Invest along three themes of 1, pollution prevention, 2, carbon transition, and 3, ocean conservation. It has a high emphasis on improvers. Again, this is not a leader's portfolio. You're not necessarily going to look in this portfolio and always kind of think, hey, this is the leading ocean health stock within the fund. We are looking for companies that could be harming ocean health, in fact, but that make a very strong investment case and that we see improvement for it. So what is then the last question you asked is important. What's the role in the portfolio? There's two things. One, it's uncorrelated. Two, it's uncorrelated. Two, strategy like this, I believe, should outperform in flat to down markets. So I'll just touch on each of those a little. I mentioned it's uncorrelated. A strategy like this has little holdings overlap with traditional investment strategies or industry or indices. So it will complement a traditional portfolio. And think global equity and think it's even weighted more towards a mid-cap strategy. So if you were to plot the weighted average market cap, it's more of a mid-cap type strategy. So this is a strategy, a very unique collection of holdings that we don't think you're going to find in an asset allocation, which therefore complements it well. The second comment, a strategy of this profile should outperform in flat to down markets. And what do I mean by this profile? Specifically around the sector weights. Given the themes, a strategy like this is overweight, typically things like consumer staples, materials, and utilities. Now, these are industries that tend to perform better in flat to down markets. So if you're expecting a market that's up 25%, the strategy will hang in there, but it likely won't keep up with the benchmark. if you're expecting, middling to down markets, irrespective of your view on ocean health, I believe firmly this should be a strategy that people would want to hold. And not to mention, a lot of those industries that this strategy is overweight have been beaten up recently. So the valuations have come down, making for just a great entry point from a valuation perspective relative to the overall market. Does that answer your question?
That does. And to be clear, this is an actively managed ETF, does not track an index. You launched it in September, as I said in my introduction. Why did you choose to launch it then? Was there anything specific about the market environment relative to, say, interest rates or any other context that made the environment attractive for you?
It wasn't anything like that. We have this strategy available in other vehicles for select investors, right? And so when we think about launching a strategy, I think of three things. First is thinking long term. I think of one, strategy, two, end market demand, and then three, vehicle, which is an ETF or an SMA or another vehicle. And typically to get $1 billion plus strategy, you need all three of those to align. So you need strategy, which is people, process, performance. Performance is always exhibit A, and fit within a portfolio is always exhibit A. Two, end market demand. It needs to be, an asset class where you believe the end market has a demand for and you have flows going into it. And then three, vehicle. This to us, we joke this is the tin can that you put a product in that you're selling, whether that's an ETF, whether that's a mutual fund, whether it's an SMA, a partnership in Europe, whether it's a UCITS. It's just the tin can to distribute that to an end market. And so in this instance, we think we have the strategy right. We think we have people, process, performance. We think we have a differentiated, uncorrelated strategy. We think there should be end market demand through the ocean health theme more broadly. And we think we got the right vehicle here. So that was the thought that went into it. And we're thinking long term. So over 3 or 5 years, that's how we're viewing the creation and launch of a strategy like this.
Ocean health is a very specific thematic focus. How big is the investable universe, and how big a market is there for consumers who want to invest in a clean oceans theme?
782 stocks. How about that for a specific answer? That's the investable universe. 782 stocks. We keep a proprietary universe. It's bigger than you think. So we have the themes of pollution prevention, carbon transition, and ocean conservation. So pollution prevention, just to give you an example, think of things like up and down the value chain of packaging. That's materials manufacturing, that's CPG, that's retail. Carbon transition, think things like offshore renewable, shipping, right? And ocean conservation, think of business models revolving around the ocean. So that could be fishing, aquaculture, engineering. And when you add all those up, and most importantly, again, our focus on improvers, these aren't kind of solutions or leaders that you'd put out there as best in class. These are companies that could be harming ocean health, in fact, but that we think could turn that negative to a neutral, that negative to a positive. And we think there's a very strong investment case there. It really widens the overall universe that one can invest in.
Where else is Rockefeller going to expand its offerings, in ETFs or anywhere else?
Well, I may have showed my hand with the attractive areas of asset management, but as one can imagine, we're positioning ourselves to what we think are those attractive areas. So getting more active in things like U.S. small cap, potentially municipal high yield, long short. We already have an offering there that I believe is attractive. Private equity, private credit, just niche, differentiated, uncorrelated. We're going to continue to roll out strategies there where we think we have a view that can deliver that performance, access, and reporting to our end clients.
Is there anything else you want to make sure our listeners know about what you and your team are up to?
These are volatile markets. I want to highlight just 4 areas briefly where you have small cap, long short, fixed income, and thematic. And within U.S. small cap, right, these stocks are cheap right now, especially when compared to U.S. large cap. But cheap alone doesn't make for a good investment, right? We think about what closes the multiple gap. And as you come out of a challenging economic market environment, small caps typically grow faster. And as we look forward, they could start growing faster than large cap stocks, especially when you consider the structural tailwinds from reshoring and deglobalization. So that may enable earnings growth to be longer lived than what you've seen in prior cycles and be a multi-year phenomenon. In you'll see reshoring through things like the Inflation Reduction Act, the CHIPS Act, the Tax Cuts and Jobs Act. So all of those will encourage that. And it's an asset class and area that we think a lot about. The second thing I'd want to mention is long short. I mean, we're in a world where, big tech and bonds are correlated. I mean, think about it, like big tech and fixed income are correlated, right? Rates go up, you're seeing, your big tech stocks go down. So where do you go for diversification, right? We think about long short strategies, think 40 longs, 40 shorts, high conviction, where you could go low net long exposure, read the net short. Third thing I want to mention is fixed income, right? In this rate environment, I mean, we're seeing it, everyone's seeing it. Low minimum, tax efficient SMAs. You're seeing just a huge inflow into fixed income to capture, fixed income that we haven't seen in over 10 years. And then the fourth thing are these thematic strategies, just capitalizing on these mega trends that we think will have decade tailwinds, that'll benefit from changing regulation, that'll benefit from technological advancements, that'll benefit from changing consumer behaviors, what we're seeing with the next generation consumer. Those are good long-term investments in our view that could complement an overall traditional asset allocation. So those are, if there's anything else to add, it's that, and what you'd leave your audience with is that. And as far as, what's the call to action, if anyone has additional questions on these or interested in learning more, whether about the ocean strategy or small cap, long, short, fixed income, or thematic, they can feel free to email assetmanagement@rockco.com, assetmanagement@rockco, ROCKCO.com.
Wonderful. And we'll also include some links in the notes that accompany this podcast. There'll be a link to the Rockefeller Capital Management website, as well as a link to the fact sheet for the KraneShares Rockefeller Ocean Engagement ETF, ticker KC. Casey, is there anything else you'd like to add?
Just last comment, I did not name that ticker, to be clear. That needs to go on the record.
Got it. Well, thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Casey Clark of Rockefeller Asset Management. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.